Hi, well, afternoon, everybody. Hope you've been enjoying your time here so far. As mentioned, we're going to be talking about investment trends to watch for 2024. So I'm Rebecca Burford. I'm a partner at Gowling WLG and head up their tech venture capital team. And I'm joined by an amazing panel today. We're going to have a really interesting discussion. So just going down the line, if you could introduce yourself, that would be great.
My name is Tim Levene. I'm the CEO and founder of Augmentum Fintech, which is the UK's only publicly listed fintech venture fund.
Kevin Chong, I'm sort of founder and general partner at Outward PC. We're an early stage fintech and investor in fintech and connected sectors.
Steve Gibson, I'm a partner at 13 Books Capital, and we too are early stage fintech investors.
Hi, I'm Sophie Winwood. I'm operating partner at, an early stage fintech VC. We focus on Europe and the US. I'm also the CEO and co-founder of WVC, which is a community promoting, including and empowering women in VC globally.
That's brilliant. And we've got a really broad range today, which is fantastic in terms of the check size that's written. It ranges from 250K through to 10 million. Across a broad church of round sizes, from a couple of 100,000 through to hundreds of millions. So great section there. So we hear a lot about the winter of 2023. We know it's been a really tough climate. It'd be interesting to hear how Q1 has gone for each of you so far, and what are you feeling? What's the sentiment for 2024 looking like?
So I think you asked me that question at a good time because we had our Q1 review this morning. So in terms of companies that we've engaged with in our pipeline, it was up 65% on Q4 of 23. So I think the year has started off with more momentum. I think that was expected. I think the question is that momentum going to continue? I think some of us are on this panel last year, we talked about how challenging 23 was relative to 21 and 22, and I think we discussed that those were anomaly years, years that won't be seen potentially ever again, and I think we need to look back to 2018 and 2019, and I think the industry is in good health, and we'll talk a little bit about the capital available, but 24 should be a stronger year than 23, but I think the momentum is behind us and the capital is there. So I think over the next couple of years we will see record years once you take out the anomaly years of 21 and 22.
And Kevin, are you finding a similar story?
Yeah, I think very similar to what Tim was saying. I think that definitely the pipeline has picked up significantly. We're only 3 months into the year. I think it's definitely looking a lot better than second half of last year. Personally, I think it's a really exciting time to be investing, to be a founder in this environment, because I think what we're going to, and it's not just about 24. I think it's 25 as well. I think these next couple of years we're going to see companies, fintechs being built that are going to be a lot more sustainable. They're going to be sort of wider as well in terms of their focus, and also they're going to be focusing on areas that are going to be a lot more profitable than what we've seen in the last generation of fintech.
Yeah, I agree with everything said thus far. I think the 22-23 bubble is a bit of a 21-22 bubble is a bit of a sort of micro moment, but the sort of more macro trend is that really smart young founders every day want to start their own companies and build their own version of something better in these markets. Financial services is still the biggest profit pool in all the industries you can be building into. And the quality of founders coming through over a 5-10 year period, and the number of founders coming through over that period is just going up and up and up. And I think what you can see in Q1 is people have stayed out of the market for a while, quite rightly. And what you now see is them coming back in Q1. So the quality has gone up, and certainly the volume. I think we're all really busy at the moment. And there's a lot less capital for European fintech founders right now, so the market's moving more slowly, but the quality is definitely still there.
The quality's there, that's good.
Yeah, for sure.
And Sophie, Q1 for you?
Yeah, I think at the start of Q1, I'm in a sort of women in fintech WhatsApp group, and someone put on the WhatsApp group, does anyone have any reports saying that fintech isn't dead, please? But I think, now we're all looking a lot more positive. Everyone's back to that kind of bleary-eyed busyness, which is a good thing. And as we've been saying, we're actually seeing really quality founders jumping out of fantastic, stable jobs at either incumbents or the kind of tech challengers who are just like, yeah, this needs to be solved. And I feel like this stat gets quoted a lot, but fintech is only 10% of the financial services industry. So we still have a huge amount to go after in terms of pie. So I think given that we now have a bit more data about, the Fintech 1.0, what works in terms of we're seeing challenger banks are working, maybe robo-advisors aren't, then actually that next generation of fintech builders can really see actually, this is the area that there's still white space, and this is the area that we don't want to go on because it's busy or consolidating.
It's interesting you talk about fintech. I think just taking a step back, how do your funds define fintech, Tim? Is it broad? Is it narrow?
It's as broad as you want it to be. I think if we asked everyone in the room what they define as fintech, we'd get a couple of hundred different answers. I think, for us, and for many of my kind of peers in the VC space, we will bucket, insurtech, regtech, traditional kind of fintech under the same umbrella. And then there are some really interesting emerging areas where there is a real intersection. Climate is an area that we're looking very closely at, where that does intersect with fintech, whether it's energy trading, whether it's data analytics. These are all areas that we really feel are, if not financial services adjacent. And I think we feel we've got that expertise that can really lend itself. So I think, that's for us. It is a much broader market when we define it as pure financial services. But as Sophie said, the market is still significantly underpenetrated. And if you just look at pure revenue, we're talking about a $15 trillion global revenue opportunity in traditional financial services, of which fintech revenues we think are about 350, 400 billion, so single digits. So this is an industry that has a long way to go. There are going to be hundreds of multi-billion-dollar businesses built over the next decade, hopefully many of which in Europe, in particular in the UK. And I think that's what excites us all around the table, that the opportunity is ahead of us, despite the fact that we've been on a sentiment roller coaster over the last 24 months.
Yeah, that's interesting. And Kevin, just from your perspective, that cross-section between fintech and other industries and what you're seeing, some of the investment opportunities that you're coming across and what's exciting you?
Yeah, good question. I mean, in our case, we've always been a fund that where we try and imagine what financial services is going to look like in the future, right? And when we do that, we start thinking about how it intersects with all the sort of big problems in the world right now. We think, and currently, these would be healthcare, education, climate, Web3 as well, and then we sort of imagine what the intersection is going to be. So I'll give you an example. I mean, if you think about healthcare, obviously, we're living in an age where people living longer, they're getting older, they're working for longer, and you've got an environment where the public health systems are failing. Where's the sort of fintech angle in that? Which inevitably I think it's going to be about the solution is going to be employer provided, some sort of insurance. PMI hasn't changed in decades, so we take all of that into the mix, and then we think about when we look at a startup, the important thing for us is it at the right stage, and then it's sort of as a secondary thing we think about does it fit into that framework that I've just talked about? Like, is there an intersection between fintech and these big problems in the world? So in our case, it is broad. There is some method to it, but what we say to founders when we meet them is like, just tell us if you're at the right stage for us, and let us decide if it's fintech.
Yeah, no, thank you. That's really helpful. So Sophie, you invest across Europe and also US, is that right?
Yep.
Yeah, so historically, I think the UK and the concentration of fintech companies was really strong. Are you seeing any trends around that expanding into Europe more and the UK not being the centre?
Yeah, I think I am. I say that with hesitation because I work for Innovate Finance, and I think one of the beauties of London is that we are this hub for innovation, and we have been seen as the global leader of fintech. One of the things we say is, isn't it amazing that you can walk from a VC office to the government, to the Treasury, to a bank within sort of 20 minutes, and that really kind of enables this network effect to grow. And I think we are still benefiting from that, but we need to not get complacent. I think all of us are seeing a shift in terms of our investment, the companies we're seeing, and our investment volume broadening across Europe. Tim was saying if you go to Paris now, you can feel that buzz. We've seen some incredible companies raise rounds, really significant rounds for fantastic businesses. And so I think that's a great thing for fintech because that's what we want. We want it to grow, we want to diversify. But as a kind of born and bred Londoner, I would love to kind of see us maintain our crown, and I think that requires a lot of focus from great initiatives like Innovate Finance to the government support to kind of just making sure that there's enough capital available.
So more competition now, effectively.
Yeah.
Yeah. And so Steve and Kevin, you're currently raising funds at the moment. How's that? Is it challenging?
I'll let Steve go first.
Well, I mean, there's, I think in every asset class right now, there's less liquidity and there's less funds available no matter who you are and what you do. If you're a founder sitting in this room or you're a VC raising money almost on behalf of founders. But I think relative to 2018, 2019, it feels similar. Relative to 21, 22, it obviously isn't. But if I think about our portfolio, generally the process of less capital being available has really focused people on building much tighter, operationally focused business models. And I think it is a fact that the best companies come out of tough periods. So I think this is okay, but it is obviously a fact that there is less money available for venture firms and founders of venture firms. And therefore, when you're in that market, you have to be absolutely ready for that. You have to be really on your game. You have to know exactly who you are and what you're asking for, and you have to have very good information about the claims you're making. So I think if you're building a business over the next 15 years, you're going to go through many oscillations where the market is kind to you and the market is not so kind to you, and you've just got to be ready for that.
Yeah, it's a tough climate, but there's still capital out there.
Yeah, I mean, I think the good news is, relative to 18 and 19, we've got far more dry powder than we've had arguably at any previous point in history other than the anomaly years. And I think when you have too much capital in the market being given to too many companies at too high a price, you see a lot of ill discipline in the market. And I think we've seen a reversion to what we think are the right type of founders who are behaving responsibly, recognizing that they need a path to profitability. We're not looking for profitability on day one. We want to really help these businesses scale. And I think that recognition has taken some time, I would say, for the fintech community to come to terms with from 21 and first half of 22. But I think we're seeing a very different approach, mentality from founders. I think investors are kind of articulating what they're looking for. And that's where you'll see some fantastic businesses being built, where you have scrappier founders with less capital having to prove more in a shorter period of time. But ultimately, history will show you that in these troughs or relative troughs, that's when those great outcomes have happened. And we only need to point to 2012, but 2008 in particular, where you saw some extraordinary outlier tech stories. And I think we're going to see some phenomenal businesses come out of 24 and 25. Arguably could be one of the best vintages, certainly in fintech in Europe, that we've seen.
Yeah.
I think generally what's great about the current environment, I mean, whether you're a founder, whether you're talking about investors, you're talking about LPs and funds, people who are active in the market right now are just so much more committed than they were, in 21, 22 when money was free flowing, right? I think the people who are doing it right now are doing it for the right reasons. The investors in the funds are much more active in terms of supporting the companies. For all those reasons, you've got all the right ingredients right now to be both building a fintech and investing.
And just to add to that, I think the other thing that we're seeing is that during the highs of 2021, you had a lot of people piling into fintech who were more generalists, and they have subsequently got burnt. And so, but all of us, we were there in the hard times. We stayed. We were staying investing in fintech when everyone was running away.
And you're still here.
Exactly. And I think that you're now getting a better understanding of who really understands fintech, who sees the potential, who gets a lot of work, and there's this horrible regulatory bit and different dynamics in terms of unit economics. But that on a good side, that's you'll get an investor that understands your business model, that'll be able to help, and will kind of foresee some of these risks that will come up.
It's interesting. So there's capital available. We've got fintech experts. So you need a fintech fund. But what about valuations? What are we seeing in 2024? How has everything we've heard impacted that?
Yeah, I mean, I think valuations have clearly come down from the highs. We're still seeing outliers, for sure, but I think there has been a narrowing of the bid and the offer amongst the investor community and the founder fintech community. And I think investors are looking for different characteristics, perhaps, than what they were looking for 2 or 3 years ago, or I should say certain investors were looking for 2 and 3 years ago. I think there is more discipline. We are quite valuation focused, and we walked away from a huge amount in 21 and 22. We're still kind of being outbid in parts by funds where I talked a little bit about the intersection with climate. You've got dedicated climate funds, you've got AI funds that are still arguably overpaying, and I would say AI is at the top of the hype cycle at the moment. But I think those pure play fintech opportunities, we are seeing relative value, and that's why, I do think the vintage should be very strong over the next, 2 to 3 years. And, as a result, I think when you have more realistic founder community in the fintech ecosystem and investors that remain disciplined, that's when you start to see the kind of those returns flow through, which we're not going to see as the norm from those vintages in 21 and 22.
I think sort of going back to Kevin and Tim's point earlier, that the first version of fintech was very much about the digitization of traditional finance, credit, lending, banking, payments. Fintech now has sort of expanded into, the creator economy. How do you monetize gaming? The digital market. So the expansion has been quite dramatic. When you think about the 90s, people used to call certain stocks internet stocks, and then every single company became an internet company. There was no more definition around, and that's the same for fintech. You can see a monetization event appearing in all sorts of industries that now that industry wants to own and commercialize in some way. And as a VC, you're looking always for white space. You're not looking for the 11th best payment firm so you can pile on 4 years late. You're looking for somebody that's being creative, ingenious, pioneering in these new markets. And in those markets, you definitely want a fintech partner to help you scale your business. But also those markets, they will have oscillations of valuations that make no sense to you because they're sort of outliers. So, this time last year we weren't talking about AI in the way that we're talking about it now, and all of a sudden there's a whole list of AI funds that are now competing with us in those markets, and that will continue to happen. So valuation oscillation will always be part of what we do. But if you're a founder, you want to pick the partner that's going to be there for you all the way through your journey. And I think that's generally the perspective we would have in the founder conversation when you're in those decisions.
Yeah, so I guess it's worth talking a little bit about follow-on funding and what are we currently seeing in terms of follow-ons? Are they difficult to close at the moment, or?
The follow-on market's an interesting one because what's happened is, and this is kind of specifically at the early stage, venture capital's like steps, right? So you raise money, you reach certain milestones, you raise money again, you reach certain milestones, and they have predefined terms and predefined investor types. And the seed to Series A jump has just got a lot harder. It needs a lot more capital to get there. It needs a lot more things to be figured out. Go-to-markets become expensive. You need to get the right talent. And so we're seeing a lot more bridge rounds or inside investor rounds between that seed and Series A. And the speed of that really depends. It just depends if you go outside to other investors, they need to get to know the business. Is it like, I was going to swear there, crap, we're running out of business, we're running out of money next month, we need something very, very quickly. But I think everyone's a lot more cognizant of capital. You can't just click your fingers and get capital. Therefore, there is a lot more focus on forward planning, cash management, budgeting. And that is on us as investors as well to say, look, this is not the ride that you're used to, and we need to think 4, 5, 7, 10 steps ahead in terms of how you're bringing in that capital, having different plans. And so I think it really depends on a case-by-case basis.
Yeah.
Yeah, look, I think because there are going to be more bridge rounds being done in this environment, right? Fundamentally because people are all trying to extend their runways to get that little bit more validation, because you don't want to be sort of fundraising when you don't need to. And I think because of that, it's now becoming more important who you've got as investors on your cap table, because the people that are going to help you get those bridge rounds done and are going to be your existing investors. Whereas, in that sort of period, 21, 22, when money was free-flowing, sort of money was coming in from all directions. I think now it's just become that much more important. I think the choice of who you've got on your cap table, are they going to be supporting you through those next few rounds? And it could be bridge rounds, it could be a smaller Series A than you're expecting. It's now become that much more important. I think it was less important in 21, 22. It's much more important now.
Yeah, I think that's a really good point. Differentiation was less of a opportunity to convert in 22. It was just who could act quicker and pay the highest price. And we had a lot of debates with founders about why that wasn't a good thing. And I was on this stage 2 years ago saying the tide's about to go out. We're going to see who's swimming without the swim shorts. And I think we've seen that, and we've seen the disappearance of a number of funds who weren't in it for the long term. We've also seen a lot of corporate venture. In a bull market, they like to get involved with venture because it's fun and it's exciting and you can get their hands dirty, and then they realize they get their hands dirty and it's a lot harder than they thought, and then they all look for the parachute to get out of the market. And we've seen that as well. So I think for founders, it is so important for them not to just look at today, but do the due diligence on the money that you're taking. Are they going to be there during the tough times, and are they going to be there for the long term? Because it is a rare scenario where it's all plain sailing. I've been involved in so many businesses over the years, and even the most successful ones that have, thankfully ended up, with multi-billion-dollar outcomes, have had unbelievably challenging times on that journey. And if we hadn't have stood by them, or had investors that stood by us at the time when we were building them, it would have been a very different situation. And that's certainly a source of frustration for me over recent years, is that founders just haven't done as much due diligence on the investors as investors have done necessarily on the founders. And I think it's really important for both sides to really go in with their eyes open, because it's a marriage. It's a long journey. Yeah. And it doesn't always end up with a great outcome, but you want partners who are going to stand by your side on that journey.
Yeah, fantastic. That's been really, really insightful. So I think fintech experts that will take you through the journey, a bit of a realistic expectation around valuation. And I think one of the most important takeaways is that if you are a founder out there and you manage to do this in this climate, it is what we've heard is a vintage year, so you're all going to be unicorns.
Easy.
So so thank you very much.
Thank you.
your time today and all your wisdom. We really appreciate it.
Thank you.
Thank you.